5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to this episode of the Follow the Money podcast. Great to be here. I'm your host, Jerry Robinson. This is episode number 509, and today's episode is titled Wall Street's Retirement Trap. Really blessed to have my very good friend on today as a guest. His name is Barry James Dyke. Many longtime listeners will remember Barry from past appearances here on the program. He's also joined us in person at our Follow the Money summits. And I've always appreciated his work because Barry is simply just not afraid to ask the hard questions. He is the author of the eye-opening book, The Pirates of Manhattan, and his latest book is The Retirement Ruse. And he has another new book coming out soon called Black Eyes for BlackRock. So in this conversation, Barry and I are going to talk about the retirement system in America and why so many people are being trained to think about retirement in the wrong way. Most people are taught to ask one question: how much money do I have, right? But in retirement, the better question, as you're going to hear as we discuss this, is how much dependable income can my money produce? Now, that's a very different question, and that's where Barry's work is so valuable because he looks at the machinery behind the curtain. He looks at the 401ks and the target date funds and the collective investment trusts, which you may learn about today. Also private credit, which has been all over the news lately, Wall Street fees, and the so-called 4% rule. And you're going to hear Barry say something very important in this interview that every retiree and pre-retiree should understand, and that is that the stock market was not designed to produce retirement income. It was designed for capital allocation. But that doesn't mean stocks are bad. You know that I believe in owning high-quality assets and following major market trends, but remember, growth and income are not the same thing. And when someone is 5 years away from retirement, already retired, or trying to create a stable paycheck from their life savings, the conversation simply has to change. So in this upcoming interview, Barry makes the case that America's retirement system is broken and that too many workers are being pushed into complex products that they don't fully understand, and the sad truth that the biggest firms on Wall Street often benefit whether the retiree wins or loses. We also delve into the 4% rule and the dangers of sequence of returns risk. We've talked about these before. In fact, our last episode, episode number 508, we actually got into some of those topics. But he also talks about the rise of target date funds, which are very important, and why contractually guaranteed income deserves a much more serious discussion. This is a fun interview, and I think you're going to find it eye-opening. So with that, let's get straight into my conversation with Barry James Dyke. All right, today I'm pleased to welcome back to the program my good friend, Barry James Dyke. Barry has been a longtime guest here at the Follow the Money podcast. Many of our listeners will remember him from past interviews and even from our live Follow the Money summits. He's the author of the book, The Pirates of Manhattan, a book that really opened a ton of eyes on how Wall Street, big banks, and major financial institutions operate behind the scenes. One of his latest books, The Retirement Ruse, we've talked about before in the past. He takes aim at some of the most common assumptions people have been taught about retirement planning, including the 4% rule, the 401k, the target date funds, and the idea that Wall Street has somehow built a retirement system that truly serves the average American. He pretty much blows that up in his book. Barry's also one of those voices that I always love hearing. I really appreciate what he has to say. He's not afraid to ask the hard questions, and he follows the money like we do right here on this podcast. Today, we're going to be talking about things and where they stand right now, what has changed over the last few years, and what retirees and pre-retirees should be thinking about, and why retirement income may be one of the most misunderstood issues in personal finance today. Barry James Dyke, it's wonderful to have you on the program. Thanks for coming back.
It's great to see Jerry, and I love you and your family, Jennifer. I just think the world of you guys, and Boy, it's hard to believe, man. We've known each other 15, 20 years, something like of that nature.
It's really nuts. And I know that our members here at Follow the Money and many of our listeners greatly appreciate you and your work. I know you're not a stranger to them. Barry, it's been a couple years since we talked, and since we've had you on the podcast. Give us the big picture. What are you seeing right now as you look out at the landscape? What are most investors and retirees missing right now?
I'm missing the big picture, Jerry. What is going on right now is instead of it being subprime mortgages, we're seeing essentially a contagion going on now with private credit. All these major business development companies, which hold private loans, if you will, the major ones, and I'm not making any of this up. It's all matter of public domain and record, but all these giant private credit firms sponsored by Apollo Global, KKR, Ares, Blackstone, BlackRock, you name it, they're blowing up left and right, Jerry. And this is what they want to put into people's 401ks, if you can believe it. And with the President Trump's his executive proclamation, if you will, is August of 2025, where they want to put essentially a lot of these toxic private loans into people's 401ks. The problem is private equity is having a problem exiting investments, Jerry. So what they want to do is find the greater fool, which is the retail investor, or as they say in the UK, they call them Muppets, which I think is more better description. So what is happening is that people, being taken to the cleaners, and again, it's something as old as the ages, but it's about gambling with other people's money. And I think now more than ever, Jared, people have to know what's going on. And then there's some other things which are going on is the use of what is called collective investment trusts. Are you familiar with those at all?
We've talked about those recently. Explain those to our audience. I find those to be very interesting.
Well, essentially, collective investment trusts, they're kind of a side door. See, Wall Street wants to get into retail savers' assets. There's roughly about 12 trillion in IRA and 401k money, which is cash because they can't get exits out of their investments. So they're essentially prohibited in SEC mutual funds right now. Well, there's a side door to that one, but what they want to use is what's called collective investment trusts, and when they're collective investment trusts, Jerry, they don't have to be registered with the SEC. There's no requirement for a prospectus. There's no disclosure. You have to go through your advisor, whoever you're getting the plan through, to get information on your investment. And it's a way to stuff private equity, hedge funds, private credit, you name it, into 401ks. And the thing is, there's roughly, I think, I'll have the exact numbers, but there's roughly about 4.5 trillion in 401ks right now, Jerry, and more than 55% of that stuff is in collective investment trusts, which is like the horse is out of the barn. So, and people don't believe me. I suggest them Googling this case called Intel Corporation, and I think everyone this is a matter of public record because, after all, the Biden administration lent Intel Corporation, the chip maker, $10 billion in 2024, and then Trump invested another $9 billion for a stake in it. And this is a case of what's been going on since 2008, where they actually stuffed private equity and hedge funds into 401ks, into collective investment trusts. And I think it's going to be coming up into the Supreme Court. So the thing is, some of this stuff is already going on. And these are the facts. People don't believe me. Google it. Use your chat GBT, what have you, and it's all there. So the thing is, I think now more than ever, Jerry, I think people need to insulate themselves, protect themselves from these Wall Street encroachment onto their savings. And this is why I've come to the conclusion that people should be using annuities and things like that more than ever, really, but only using mutual or fraternal organizations, which would be, church or regulated companies or mutual companies which are owned by the policyholder, because Wall Street is up to its shenanigans, and I think this is bigger than the subprime crisis. That's just my opinion.
Hmm. We think about America, we think about, as you're talking about all of that, it does make sense, but it also doesn't make sense, Barry, because when you look at, for example, the United States and our healthcare situation, the healthcare situation here is a disaster. And here we are, the richest country in the world. So you think, how in the world could this be? Or look at the education system here in the United States, the same situation. And when you really drill down, you start to see, well, a lot of this is a lot of government red tape. A lot of it is corruption, just straight out, corruption. But when we look at the retirement situation, you and I were just talking about a study. Maybe you could share that with the audience, but it showed that we're behind in retirement planning too. What's the deal? I mean, why is America falling so behind, not just in healthcare and all these other things, but also retirement planning?
It's god awful, Jerry. We are the number one economy in the world. And as I was saying pre-interview, I think, America's a great place if you're very rich to retire, or if you're, collective and bargain union employee, i.e. a government, you're going to be fine. You're going to get a true defined benefit annuity. So those people are protected. As a matter of fact, Biden, with his Inflation Reduction Act, he actually allocated $92 billion to bail out essentially underwater multi-employer pension plans, and the largest being Central States Pension Fund, and for $35 billion. This is a matter of fact. No one's talking about it, but this is all true. So the problem is, Jerry, in light of this, is that, and I've been tracking this for a number of years, but there's a company, an actuarial firm called Mercer out of Australia, and they track all the worldwide pension systems, retirement systems from all your major countries across the world. And we get worse every year. Okay, so in the top 30 retirement plans and the best ones, the U.S. ranks number 30 in the top. So we're essentially in the cellar. Mexico actually is like around number 18 or 19 or something like that. So you have a country like Mexico has a better retirement system overall rated by this independent actuarial firm. Now, the irony of the whole thing, and this is all true, is that all the best retirement systems, i.e. from the Netherlands, Iceland, Israel, Norway, Singapore, all these countries which consistently have the best retirement systems, Jerry, they're all annuity based, they're all guaranteed based. So I've been doing this for a long time, over 40 years, and I've learned the first thing about retirement systems is that it's produced retirement income. It's not to speculate. And I'm not against it. I'm a capitalist, okay? We manage a good amount of money, but the thing is that we've just forgotten this. We've gotten so far off track, Jerry. I don't know how far we get. I don't know how we got this far off track.
Yeah, it's wild. You bring up a really good point, because we are taught accumulation as is the goal. When you're planning for retirement, you think accumulate. You finally get to that place where, you reach the age where you say, well, now I want to start taking some of this. And it seems like that's the part that we drop the ball on, as far as, instead of thinking about retirement just purely as accumulation, we really need to think about it in terms of income. Instead of just account balances, we need to figure out, how are we going to cash flow this? How are we going to live off of this income? That's where you come back to annuities, which again, I think that what you said about mutual companies and annuities, extremely powerful. And those solve some of the problems for sure. I mean, people who have pensions, state-funded pensions, these defined benefit plans, like you said, that's a pretty good place to be. But the average person is told to accumulate inside of this 401k, and then they really aren't taught about the cash flow perspective. They're going to have to live off this. So building wealth is one thing, living off of it is another. So maybe talk about that part of it a little bit. How do you help your clients understand that? Because that's probably where you add a ton of value.
Yeah. So the whole thing is, people, when they, luckily, and God's blessed me, I deal with people all around the country. but people, when they get to a certain age, 65, 62, 70, what have you, they want to, they want to, kind of hang up their skates, if you will. And the thing is that they really want to enjoy all their hard work. And the thing is, we have the sequence of return risk, which is a real huge problem. And people don't believe me. Google it, please. Sequence of returns. It's really within 5 years retirement. It's a real problem.
Huge.
So the thing is, what most people want is a steady income stream. And then there's a problem with the intellectual and behavioral problem, Jerry, where as we get older, we lose our intellectual capacity to manage investment risk. So the best systems around the world all use annuity or income based retirement systems. Now we help people. We look at what they have, and again, I hate to be a snob, but at this point in my life, I don't want to see anyone get any hurt. And the problem is that what we're seeing is this crazy offshore of reinsurance and insurance risk with private equity and Wall Street backed firms, and they're going off into Bermuda or the Cayman Islands, and so we have no idea where people's savings are going. The private equity firms are in turn they're recycling this money into private credit, and then we're seeing just today it was announced, and today in Bloomberg today, where KKR, or Wall Street Journal, they both reported on it, where KKR lost like 560 million in one of its credit funds. Now we don't know where this money is being coming from, but I do know that KKR is one of the biggest players in offshore reinsurance insurance with their global Atlantic entities. And so the KKR is really big in the space, and Apollo, and is huge with Athene and so forth. And I just tell people, hey, if you hear about this stuff, I'd run, so people would be much better off taking a more conservative approach. I'm not, against people keeping money in the market, because as they keep printing money, Jerry, the market's going to go up. We know that. We know this old game. As they keep printing money, the market's going to go up. But the thing is, but for retirement income, you really want to take care of your fixed expenses and your food, your travel, whatever, all this stuff in retirement, and so you can enjoy it, enjoy your grandkids, and let the money work for you. And but thank God I know people like you, Jerry, because everyone looks like I have three heads,
Well, one of the topics that many people think of immediately when they think about retirement is they say, well, here's why I don't need any kind of contractual guarantee in retirement, is because of the 4% rule. So if I put my money in my 401k and I just withdraw 4% every year, then why in the world would I need anything else? Because it's proven itself. Hasn't it proven itself, Barry?
No, it hasn't. As a matter of fact, and the guy who actually invented that 4% rule, what was this guy? He actually retracted on that. What was the guy's name? Can you remember the guy? There was a financial plan or whatever.
Yeah, I remember. And in fact, he was just in the news not too long ago, but yeah, I can't remember his name.
Yeah, so he admitted that the 4% rule is kind of a bunch of hooey. So the thing is, a retirement income plan is meant to produce retirement income. It's not to buy another cryptocurrency or private credit or a high-flying stock, which is going to go in, or a stock like something like Beyond Meat, which is essentially gone into the toilet. So the retirement income should be, income plan should be produce retirement income first and foremost. And that's something I learned when I first started in the business. It's now more important than ever, Jerry, but we've gotten so far off track. I don't know how we got this, but it's about money and politics and the corruption in the markets.
I was just talking with someone the other day. In fact, we do a lot of coaching with a lot of our members, and one of the things I consistently see is something that you've written about in your book, and maybe you can illuminate our audience on this topic because they become so popular. But whenever I'm coaching someone and maybe they want to show me what they're currently investing in, I'm not a stock advisor, so I don't give them specific, stock advice. but sometimes they want to show me what they have, and I'll just tell them, what I would do in their shoes if it were me. And one of the things we consistently see are these target date funds, and they seem like a really good idea because you can say, well, I think I'm going to retire in say 2050 or 2040, and so you just put yourself in that target fund. And in fact, I think they often put you in it regardless, and then you have to get yourself out
Yes.
of it. But I think that's right. But anyway, so what's the deal with these? I think many people look at these and they think, well, this seems like a good solution. Why is it not, Barry?
Well, it's the power of the asset management industrial complex, Jerry. And I remember we've known each other for quite some time, and I released, people can go, by the way, go to my website, barrymajamesdyke.com. I wrote about this in my second book called The Pirates of Manhattan 2, Highway to Serfdom.
Mm-hmm.
And I wrote just because it is about target date funds. Now, target date funds, I think they get maybe 70–80% of all new inflows. So you're essentially, you are corralled into these things now, like sheep or cattle, whatever, if you will. And so this is where your money goes automatically into the plan. Now, I think breaking down a nuclear submarine is easier to figure out than a target date fund. There's so many moving parts, Jerry. I tried to, but this is where Wall Street wants to stuff their money. And the thing is, it's all about control. And it's not a bad in theory concept, but the fact is we don't know what the future is going to bring. We don't know what interest rates will be. We don't know what the stock market will be. We just don't know. So it's more about funneling money to the major mutual fund companies, whether it be Fidelity or Vanguard or T. Rowe Price, whatever, or Empower. They control most of the market, and by funneling them into target dates, the reason why they do this is because they don't want to have litigation. So unfortunately, it's not about doing the right thing for the employee, the retiree. It's really more about for the employer to avoid litigation, and which is because Wall Street or we can't compete with the lobbyists, but so people are forced into this stuff, and the reason why employers like it because they get a liability shield. Does it mean it's the best thing for people? No, not at all. And so there's real limits to this. And actually, that kind of gets into my next book, but which I'm talking about. So there's a real need for prudent retirement income, and which does not target date fund. It was never meant to produce income. The only purpose of the stock market is to allocate capital. It was never meant to produce income. I don't care I'll talk to anyone about that. A stock market was never made to produce retirement income, Jerry. End of story. So what we have though, but through the control of Wall Street and the asset management industrial complex, we're being told that. And it's quite frankly, it's a lot of BS, if you will.
For a lot of the people who may not be familiar with your work, Barry, and I want to talk about your new book in just a second, but one of the most interesting points you've made over the years, and you've made many, is the idea that banks and major corporations and institutions will use annuities and life insurance for stability while pushing high risk assets without any kind of contractual guarantees upon the public. Talk about that briefly, because some people who may not be familiar with your work may be stunned by that.
Yeah, it's still true. As a matter of fact, I was talked to. Funny, it was one of the top Wall Street reporters called me on Friday. This is a true story. Guy from Grant's Interest Rate Observer. I've never heard of them, but it's probably one of the best. It's a subscription, very expensive subscription.
Yeah, I've actually had James. Is it James Grant who runs
Jim
Grant?
Yeah.
Yeah, Jim Grant. Yeah, I've had him on the show. Yeah, he's quite a guy.
Okay, so he has probably one of the most high-priced interest rate observers. But anyway, so one of his top reporters was calling me. This is funny. It's on Friday, Jerry, and I said, this guy Evan, and I said, Evan, do you know who the biggest purchasers of life insurance and annuities are? He says, I don't know, wealthy people. I said, no, wrong. I said, no. I said, where do you deposit your money? He said, banks. Says, banks, the biggest, largest. Yeah, still to this day, Jerry.
Hmm.
Now, this is, and I'll testify in court or whatever, God strike me dead, whatever. But even to this day, Jerry, the major banks, your JP Morgans, your Wells Wells Fargo's, Citigroup, excuse me, Bank of America, all these banks, they all have major positions in cash value life insurance. And I would, swear on a stack of Bibles on this. Now, the fact of the matter is, I've actually been interviewed by Bloomberg about this and other people and other very sundry, the Journal, but no one wants to publish this because it would piss off their advertisers. So the fact of the matter is, the banks cannot even actually put their reserves, Jerry, in. Regulators will not let banks put their reserves into stocks because it's so volatile. They don't want that. So the tier one assets, which is the important part of any bank or any insurance company, if you will, but the tier one assets are the most important because that's the cushion for economic shocks, which always come about.
Mm-hmm.
So the only assets you can put into tier one capital, Jerry, and this is the Federal Reserve, and people go to barrymajamesdyke.com and go to the book Paris Manhattan, and they can put cash value life insurance, annuities, gold, mortgages, cash, T-bills, that type of thing, very high quality assets into the tier one capital. They can't put their money into stocks. Now, it doesn't mean they don't do their investment banking by warehousing stocks and stuff like that, but for their own account, Jerry, they can't put their reserves into stocks. And so and most people don't understand how leveraged they are. Jerry, I mean, during the last financial crisis, as you know, the banks, Bear Stearns, Lehman Brothers,
Sure,
Deutsche
yeah.
Bank, they were all levered 30, 40 to 1, Morgan Stanley 30 to 1, highly, 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 highly leveraged. And so the life companies, they cannot do that. So the banks actually, they get it. Is it a boring investment or a savings way? Yes. Is it stable? Yes. Are banks stable? No. So I think, but people need to understand that insurance companies, from a pure engineering perspective, Jerry, are going to be more stable than a bank. But I would say you'd almost eliminate 50, 60% of these companies because if they're backed by private equity or Wall Street, they're going to be even more leveraged because the typical stock-owned company, Jerry, or private equity company, they take up most of the reserves or surplus out as income and dividends to themselves. So I tell people just to run.
You're listening to the voice of Barry James Dyke on the Follow the Money podcast. He is an author of many different books. We're talking about his upcoming book now. I want to shift gears, Barry, because before we conclude, you're working on a brand new book, and I'll let you tell the title. But before people go, I want to make sure they know about this and how they can get it, because much of the research that you've done over the years now is snowballing into this book. And what is the purpose of the book that you're writing right now? When does it come out? What's it about? Where can they get it?
Well, it's going to be a page turner. It's going to be called Black Eyes for BlackRock. And I explain how BlackRock became the largest asset manager in the world. And this is all verified. And courage to the U.S. taxpayer. They were born out of Blackstone, the private equity firm itself. And I explain how they essentially dominate savings in the U.S. I mean, they control the thrift savings plan, which is the largest 401k plan in the world, which is the government employees' thrift savings plan. They essentially have a monopoly on that. But State Street has a minor spot on that. But how they're giving people bad investment advice and how the downsides of indexing. And I'm not against indexing. I think indexing is a great way to invest savings, but they're like everything else in Wall Street. They're taking a good thing and they overdone it. And so, but now, and BlackRock was also a big player in the ESG the environmental, social, and governance movement, which being started in 2012. Now this whole thing is falling apart. The states came against him, and it was another. And his main advisor is one guy by the name of Tariq Fancy, and I forget the other guy's name, but two guys who worked directly for Larry Fink just said the whole ESG thing which was a bunch of phooey. And so, but now BlackRock is telling everyone to get into private credit, into private equity, and hedge funds and that type of thing, alternative investments, infrastructure investments. And, some of this stuff, Jerry, I mean, thank God for my faith. I mean, I couldn't do it, but I couldn't do it without my faith. God is the most important thing in my life. But a lot of the stuff is just wrong. And so I'm bringing actual examples up of infrastructure investments which have failed horribly, i.e., like Thames Water in the UK, which is one of the biggest utilities taking over on private equity, and it's just a nightmare. And the UK is kind of the poster child in this stuff. So, but this is what they want to do. They want to take over highways and airports and everything else, and so they can get. But it's really about fees, Jerry. It's really because so I actually document. I got information from one of the publicly disclosed prospectus online on some of their evergreen funds, and then the fees are very, very high. So they're really doing this really in search of margin for themselves. And so what I'm saying, this is in turn hurting the public, and it's because it's criminal, Jerry, because I would say, I don't know, when you look at the statistics, and I have plenty of them, people are really hurting in retirement. And so I discussed that in retirement rules, but so I said, heck with it, I don't want to be looking out of my coffin and say, I wish I did this. So God's blessed me with good health and good intellect. And so I wanted to get this out. So it should be out hopefully within a month.
That's fantastic. They'll be able to buy it at Barry James Dyke.
Yeah. So I may even put it on Amazon. I don't know. I just wanted to get out there because everything's factually based. The bankruptcies, Jerry, and I have actually a list which I'll be publishing of all the companies which have in the past. There's 3 years, Jerry, 24, 25, and 26, which have either gone bankrupt, gone into default, done a debt for equity swap, which is an out-of-court restructuring of bankruptcy, if you will, or I call it just a plain old house of debt, which is if you go one way or another. It could succeed, it may collapse. Luckily, it is probably going to collapse, about 70% chance, but I just list them. And thank God for the internet and artificial intelligence. But there's about 357 major companies which have gone into this situation. No one wants to put it together, but I just did. So I'll be giving that out to the public just free of charge. So,
wow.
See what happens.
You're making all the wrong enemies, or maybe the right enemies, Barry. Maybe we should say that. Wow. Well, I sure do appreciate your time. I know you're a busy guy. For the folks who want to learn more about you and your work, Barry, is your website the best place to go?
Yeah. People, go to barrymajamesdyke.com. You can get the books, which is good, or you can subscribe to our newsletter. So, thank God for the internet and people like yourself, and we'll keep people informed. And I'm pretty confident this one's going to be a big one because it's not just in the U.S., Jerry, but they're doing the same stuff in the U.K. And Canada, and so they're looking for the next greater fool. And I'm a capitalist, okay? I do not believe in handouts. I mean, but some of this stuff, this is very serious money for people's savings, and people are hurting, and they want to know why. And as you know, with all the massive inflation, they want to have more security, if you will. And not that there's no guarantee. If you want a guarantee, you get more if you buy a new toaster at Walmart. But when I'm saying a new toaster at Walmart has more guarantees than a 401k, so that should, that needs to change.
And And that's really where we are here in 2026, isn't it? Where people are coming to retirement and so many of them don't have those contractual guarantees. But Barry James Dyke has long been a part of our advisor referral here at Follow the Money. So when you reach out to us and say, hey, I want to find a good advisor, we've tried to create a good, a good stable of advisors who we trust. Barry is one. Barry lives up in New England, so he serves a lot of folks up in that area. But Barry, it's been a great thing to catch up with you again. And thanks for all the information and this upcoming book. We'll be sure to promote it when it comes out. God bless, my friend. Thanks for
God bless. Now, you're going to be putting that on a YouTube, whatever. I'd like to send it out to my fans, whatever, because you've always had integrity, Jerry. I mean, I think the world of you and Jennifer, and just the integrity about telling the people the truth. You going to be coming out with the YouTube on this, maybe, perchance?
Oh, yeah. It'll be coming out on YouTube shortly, probably by the end of the week. So.
Oh, great. Yeah. So we can get out there. Yeah. Cause I haven't, it's been a lot of logistics getting this whole book together. So
I'm
want
sure.
to jinx it, but anyway, this will be great. And I will probably see you in Nashville.
I will see you there, my friend. God bless you. Good to see you.
God bless, man.
All right. Take care.
Take care. Bye-bye.
Hey friends, Jerry Robinson here from followthemoney.com. Before we continue with today's podcast, let me just mention something really quickly. If you've been listening to the podcast for a while and you're starting to think more seriously about your own situation, your investments, your retirement plan, and how everything is actually structured, there comes a point where it helps to talk it through with someone. And that's why we created our Follow the Money Advisor Referral Service. We work with a network of trusted financial professionals across the country, and we can connect you with someone who can help you take the next step, whatever that looks like for you. Maybe it's reviewing your current retirement plan, or maybe it's putting a real income strategy in place, or maybe you just have a simple question like getting a life insurance quote. If that sounds helpful, you can learn more at followthemoney.com/advice, or just give us a call at 800-609-5530. No pressure, just a chance to get some clarity around where you are and where you're going.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back. I sure hope you enjoyed that interview with Barry James Dyke. I always enjoy talking with Barry because he brings the receipts, right? He's not just throwing around opinions in the wind. He's looking at the whole structure of the system. And I think that's the big takeaway from today's episode. The retirement problem in America is not just a math problem. It's a structural problem. Millions of Americans have been told to put money into a 401k, to pick a target date fund, and then to stay the course, and then somehow turn that pile of money into retirement income that they can't outlive later. But that later part is where a lot of people just get into trouble, because retirement is not just about accumulation, which is how it's kind of basically sold. It's about income, it's about risk, it's about timing, it's about taxes and inflation, and it's about that sequence of return risk, those market losses early in retirement. It's about whether your plan can survive real life. Make it clear that I am in no way, shape, or form anti-stock market. I'm not anti-401k. I'm not anti-growth. In fact, I invest in the stock market. I use 401ks, and I am a growth investor. But I am against the idea of people being led to believe that accumulation alone is all that they need for a retirement plan. It's not. A real retirement plan should answer several basic questions like, where will your income come from in retirement? What happens if the market falls early in your retirement? What part of your money is contractually guaranteed to be there in retirement? What part is exposed to risk where you could lose it all, right? What part is liquid? What part is guaranteed? All these basic questions. Who benefits from the way your money is being currently positioned? Now, there's a big question to ask. But from my experience, and certainly from Barry's, we found that many people, too many people, we might even say, Wait until they've already retired before they start asking those really important questions. And by then, the margin for error is so much smaller. So my encouragement to you is simple. Do not sleepwalk into retirement. Don't assume that the default option that is given to you from the HR department is your best option, right? Don't assume that Wall Street's plan for your money is the same as your plan for your family and your money, right? Ask better questions, get a second opinion, build a plan that's designed not just to grow wealth, but to actually live on that wealth in a wise and efficient manner. And as always, I'll leave you with a final word, this time just a simple thought that's definitely worth thinking about. And I said it on our last podcast as well. Let's reiterate it again in this episode. Most people spend a lifetime trying to build wealth and almost no time learning how to use it. Now, there's a thought that's worth thinking about for a little bit. Well, friends, it's been great to be here on this episode. And as always, remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Take care, and God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.